You just formed your LLC, congratulations. But now you're staring at your business bank account wondering, how do I actually get this money into my pocket without messing everything up? Here's the problem. Most new LLC owners either withdraw money the wrong way and risk legal issues, or they're so scared of making mistakes that they just leave all their profits sitting in the business account doing nothing. My name is Josh Burns, and I used to be exactly like you. I remember forming my LLC and having no clue how to pay myself without getting in trouble. I spent weeks researching, sat down with multiple accountants and tax professionals, and eventually figured out the system that actually works. Today, I'm breaking down the complete process, the 3 steps to set everything up correctly, the biggest mistakes that get people in trouble, and the tax strategies that could save you thousands of dollars. By the end of this video, you'll know exactly how to pay yourself as a limited liability company or LLC in 2026. Let's get into it. Alright, first things first, let's talk about the owner's draw. This is the foundation of everything. When you own an LLC, you don't pay yourself like a traditional employee. Instead, you use something called an owner's draw or owner's distribution. Think of it like this. Your business account is a bucket and your personal account is another bucket. An owner's draw is simply moving water from the business bucket to your personal bucket. Sounds simple, right? But here's where people mess up. You cannot just swipe your business debit card for personal stuff. You can't pay your mortgage directly from your business account. You can't mix these two worlds together. When you mix personal and business finances together, that's called commingling, and that can destroy the legal protection your LLC gives you. If someone sues your business, they could potentially go after your personal assets because you didn't maintain that separation. The owner's draw keeps everything clean and legal. You're creating a paper trail that shows this is business money, now it's personal money. Simple, documented, legitimate. So the rule is, business money stays in the business account until you officially transfer it to yourself through an owner's draw. Then and only then can you spend it on whatever you want. Now let me walk you through exactly how to set this up. There are 3 steps and you need to do them in order. First, you need an EIN, an employer identification number. Think of it like a social security number, but for your business. The IRS uses this 9-digit number to track your business for tax purposes. And the good news, it's completely free to get one. Just go to irs.gov or use a link below in the description and search for Apply for EIN. You'll fill out a quick form with basic info about your business, what type of entity it is, what industry you're in, that kind of thing. The whole process takes maybe 10 to 15 minutes and you'll get your EIN immediately. Write it down somewhere safe because you're going to need it for step 2. Step 2 is opening a separate bank account specifically for your LLC. And I cannot stress this enough. This is not optional. This is the foundation of keeping your personal and business finances separate. Pretty much every major bank offers business checking accounts. Some of them have monthly fees, some don't. So shop around and find one that works for you. When you go to open the account, make sure that you bring your EIN. The bank will link that number to your business account, which means that all the money flowing through that account is now officially tied to your business and not your personal social security number. From this point forward, every dollar your business earns goes into this account. Every business expense comes out of this account. This is your business's financial home base. Alright, now for step 3, actually taking your owner's draw. This is the fun part where you finally get to pay yourself. Here's how it works. Let's say you have $5,000 sitting in your business account and you want to take $2,000 for yourself. You have 3 options for transferring that money. Option 1, write yourself a check from your business account and then deposit it into your personal account. Option 2, do a bank transfer or ACH transfer from business to personal. Option 3, withdraw cash from your business account and then deposit it into your personal account. Now I strongly recommend options 1 or 2, the check or the bank transfer. Why? Because they create a digital paper trail. If the IRS ever audits you, you can pull up your bank statements and show exactly when and how much you paid yourself. But here's the critical part that people forget. You need to document this in your records. Create a simple spreadsheet or use an accounting software like QuickBooks Self-Employed. Record the date, the amount, and label it as owner's draw or owner's distribution. This documentation is your insurance policy. If anyone ever questions your finances, you've got clean records showing exactly what happened. Now here's something really cool about owner's draws that most people don't realize. Unlike a traditional job where you get the same paycheck every 2 weeks, with an LLC, you have complete control over when and how much you pay yourself. Maybe one month revenue is tight, so you only withdraw $2,000 to keep more cash in the business. The next month you land a major contract and decide to pay yourself $10,000. That choice is completely yours. This flexibility is one of the biggest advantages of the LLC structure. You can adapt your personal income based on your business's cash flow. So in lean months, you keep more money in the business to cover expenses and to build a cushion. In strong months, you reward yourself and take home more. There's no rule that says you have to pay yourself the same amount every time. You're the boss, you decide. Now let me give you a clear example of how the owner's draw works. Imagine it's December and your LLC just had a great month. You've got $10,000 sitting in your business account. You've already set aside money for taxes and covered your operating expenses, so you're ready to pay yourself. You decide you want to take $5,000 for personal use, so you grab your business checkbook and you write yourself a check for $5,000. Or if you prefer a bank transfer, then you log into your business bank account and initiate an ACH bank transfer for that same amount to your personal account. Next, you head to the bank. Or if you did a transfer, then just wait a day or two for it to clear. Once that $5,000 hits your personal account, you open up your bookkeeping spreadsheet or accounting software. You create a new entry, December 15th, amount $5,000, category owner's draw. Maybe you also add a quick note, personal distribution for December. That's it, the transaction is complete, properly documented, and totally legitimate. Now that $5,000 is yours to use however you want. Pay your rent, buy groceries, invest it, save it. It's personal money now, and you can treat it like any other income. And here's the thing, after you do this process 2 to 3 times, it becomes second nature. It's really not complicated. The most important part is just being consistent with your documentation. Every time you take a draw, record it every single time. That consistency protects you legally and makes tax time so much easier. Alright, now let's talk about the mistakes that get people in trouble, because knowing what not to do is just as important as knowing what to do. Mistake number 1, taking too much too soon. Here's what happens all the time. A new business owner sees their first $5,000 or $10,000 hit their business account, and they think, finally, I'm making money. So they transfer almost all of it to their personal account to celebrate or catch up on bills. I get it, it's tempting, but it's a recipe for disaster. Don't do this. You need to leave enough money in your business account for 2 critical things. Number 1, operating expenses. You've got software subscriptions, freelancers, maybe rent, equipment, advertising cost, all that stuff needs to be paid. Number 2, taxes, and this is the big one that catches people off guard. When you're self-employed, you're responsible for self-employment tax, and that's 15.3% on top of your regular income tax. That 15.3% breaks down like this. 12.4% goes to Social Security and 2.9% goes to Medicare. And if you are a high earner making over $200,000 as a single filer or $250,000 if you're married, there's an additional 0.9% Medicare surtax. I've seen people take huge draws, spend all the money, and then get absolutely crushed when tax season comes around because they didn't set any money aside or make estimated tax payments. So here's what I recommend you do. Set aside 25 to 35% of every dollar your business earns for taxes. So if your LLC makes $10,000 this month, immediately move $2,500 to $3,500 into a separate savings account labeled tax money, and don't touch it. That money doesn't exist to you until you've paid your quarterly estimated taxes. Here's another huge misconception. Some people think if I just leave the money in my business account and don't take a draw, I won't owe taxes on it yet. Wrong. Completely wrong. With an LLC, you owe money on your business profits whether you take the money out or not. The IRS doesn't care where the money is sitting. They care how much profit your business made. This is because LLCs are pass-through entities. All the profit passes through to you personally, and you report it on your personal tax return. So leaving money in the business doesn't delay your tax bill. All it means is that you'll have less cash available in your personal accounts when your tax bill comes due. Now let's talk about the good news, the tax advantages that LLCs offer. First, as I mentioned, LLCs are pass-through entities. Your business profits pass through to your personal tax return. This means you avoid double taxation. With a C corporation, the business pays corporate tax, and then when you take money out as dividends, you pay personal tax on it again. You're taxed twice. With an LLC, you're only taxed once. Second, you can deduct legitimate business expenses to lower your taxable income. Home office deduction, equipment purchases, software subscriptions, business travel, advertising costs, professional development, all these can reduce your taxable income if they're legitimate business expenses. The key word there is legitimate. Don't try to write off your family vacation as a business trip unless you're actually conducting business. Trust me, the IRS has seen every trick in the book and they will catch it. Third, and this is advanced, but once your LLC is profitable enough, usually around $60,000 to $80,000 in profit, then you can elect to be taxed as an S-corporation. With an S-corp election, you pay yourself a reasonable salary and take the rest as distributions. The distributions aren't subject to that 15.3% self-employment tax. You only pay that tax on your salary portion, not the distributions. This can save you thousands or even tens of thousands of dollars per year, but it's more complex. So you'll want to work with a CPA or an accountant to determine if and when it's right for you. Alright, let's talk about limited liability protection. This is actually one of the biggest reasons people choose to form an LLC in the first place. Here's how it works. If someone sues your business or your company racks up debt, then your personal assets like your home, your car, or your personal bank accounts stays protected. The people you owe money to can only go after what's owned by the business itself. They can't touch your personal property. This separation gives you peace of mind as an entrepreneur. You can take smart risks to grow your business without worrying that one mistake could wipe out everything you own personally. It's basically a safety net that protects your personal life from your business life. So let's say someone files a lawsuit against your company. If you've set up the LLC correctly, they can only target what belongs to the LLC. Things like your business bank account, equipment you bought for the business, or other company-owned assets. Your personal bank accounts, your home, your car, your personal investments, all those things stay off limits as long as you've structured your LLC correctly and you've kept that separation intact. And this is exactly why that separation we discussed earlier matters so much. If you mix your personal and business money together, a judge could decide that you're not really treating your LLC as a separate entity, and then you lose that protection. When you combine this liability shield with the pass-through tax treatment that we talked about earlier, you can see why millions of business owners pick the LLC structure when they're starting out. Having that protection in place is absolutely worth doing things the right way from day one. So as your business grows and becomes more profitable, those self-employment taxes are really going to start adding up. When you're making $30,000 or $40,000 in profit, paying 15.3% in self-employment tax isn't that much. But when you're making $100,000, $200,000 or more, that 15.3% becomes a massive chunk of money. This is when most business owners start looking at S-corporation status. And like I mentioned earlier, by making the S-corp election, you pay yourself a reasonable salary while taking the rest of your earnings as distributions, which are not subject to self-employment tax. This tax-saving strategy can put thousands, even tens of thousands of dollars back into your pocket each and every year. Now, I'll be honest, I waited way too long to make the switch because I was overwhelmed. S-corps come with more complexity. Payroll, quarterly filings, bookkeeping, compliance requirements. It's a lot to manage on your own. That's when an entrepreneur friend told me about Collective. They're a team of accountants and tax professionals that handle it all. S-corp payroll, bookkeeping, business taxes, compliance, everything. What makes them different is they're built specifically for self-employed people and small business owners like us. They understand our challenges and make the S-corp process manageable. If you want to check them out, click my referral link in the description and use code JoshBurnsTech to get your first month free. I also have a full tutorial on my channel walking through the entire platform. Alright, let's do a quick recap of everything we covered today so you clearly know how to pay yourself as an LLC in 2026. Get your EIN and open a dedicated business bank account. Document every single draw you take. Set aside 25 to 35% for taxes. LLCs give you pass-through taxation and liability protection. Consider S-corp election once you're profitable enough. Paying yourself from your LLC doesn't have to be complicated. Follow these steps, avoid the common mistakes, and you'll be in great shape. And if you've got questions about your specific situation, drop a comment below. I read every single one, and I'll do my best to point you in the right direction. Thank you so much for watching this video. I hope you have a great day, and I'll see you in the next one.